Hi, I'm Todd Rosenbluth, Head of Research at Vetify, and thanks for joining us for another episode of ETF 360. I'm joined by Matt Camuso of BNY Mellon, and we're here to talk about their international equity ETF. Matt, thanks for joining me.
Todd, thanks for having us.
Matt, BNY Mellon just passed the 2-year anniversary of launching ETFs. How's it been going?
Honestly, Todd, we have been thrilled with the receptivity we've received from multiple different client types, from institutions and asset managers who are big ETF allocators to your traditional financial advisor in the intermediary space. I think what's most exciting for us is the sentiment in terms of what all of these different client types appreciate in regards to our ETF offering is directly in line with how we came to ETF market from a strategy perspective. Back in 2020, when we launched our ETF platform, the idea was to bring the scale and efficiency of BNY Mellon as an end-to-end ETF provider to investors. What do we mean by end-to-end? Well, if you look at our enterprise, we have business lines that touch really every part of the ETF ecosystem, from asset servicing to primary and secondary market services to sub-advisory and now as an ETF issuer. And what this really brings to investors is two distinct opportunity sets. The first is cost savings, especially in the beta part of their portfolio. So we currently offer 8 index-based ETFs, 2 of which are actually the industry's first true zero-fee ETFs. So that's our BKLC, our U.S. large cap equity ETF, as well as our core bond ETF BKAG. So in most client portfolios, those are the 2 biggest buckets, if you will, from an allocation perspective. So offering 0 basis point products allows our clients to take down the overall cost of the portfolio. And the second is really just giving investors access to our investment specialist firms here in BNY Mellon through the ETF wrapper. So we have a lot of institutional quality active managers with inside BNY Mellon. We now have 6 active ETFs and really just looking to add choice in the market for our clients that are seeking out active solutions in the ETF wrapper.
Interesting. So where are we seeing client demand, particularly in this unusual 2022?
So to no surprise, right now it's on the index-based side. So our 8 index-based ETFs right now actually are in total of over $1.2 billion in assets under management. But we're actually starting to see the active side pick up as well. So we launched our first active ETF back in August of last year. We launched the majority of them at the end of last year in December and throughout March of this year. But I think a lot of our client conversations are actually circling around with all of the uncertainty in markets. How do I blend high concentrated or diversifying type active managers with my more index-based exposure? So our lineup just fits perfectly for that conversation, bringing in low cost, the opportunity for cost savings on the index side, but then bringing in that institutional quality type management to complement those exposures in certain parts of the portfolio. And we have seen assets start to increase on our active solutions as well. I think most exciting for us going forward, we're starting to have a lot of conversations with strategic partners internally and externally on model portfolios. So as some say, the pipeline is robust and we're excited to continue the momentum we've seen even after these short 2 years.
Given the market volatility that we've seen this year, how do you think advisors are using ETFs to build their portfolios?
Yeah, so I think, it's really looking at certain asset classes where active management can provide that diversification, whether that be an inflation hedge, whether that be to take down volatility, et cetera. So in one particular part of the portfolio we're really discussing with clients, that opportunity set is in the international developed equity space, is using just a broad-based beta ETF. So for us, that'd be BKIE, which tracks the Morningstar International Developed Index, and then complementing that with something like our international concentrated equity ETF BKCI that's managed by Walter Scott. This is a portfolio that holds 25 to 30 stocks, so high in concentration, brings the diversification to the asset class. And really the key diversification benefit for BKCI is taking down overall volatility of the portfolio. So we've actually had a client recently buy that product for that exact reason. And again, it's just looking in certain parts of the portfolio, whether it be international equities or in fixed income, that you have an active manager that can really help fight inflation, take down volatility, or help you navigate overall rising rate environment.
Matt, what makes BNY Mellon's concentrated international equity ETF unique?
Yeah, so BKCI is managed by Walter Scott, which is one of our investment specialist firms here at BNY Mellon. Walter Scott's based in Scotland. They have $94 billion in assets under management. And really how Walter Scott helps clients navigate market volatility is for looking for those 25 to 30 companies, as I mentioned, that have high quality and also have a history of profitable growth, over different market environments. Really what they're trying to do is find companies with very strong balance sheets that have attractive growth prospects that are driven not by cyclical growth cycles, but for long-term growth cycles. What that leads to is a basket of companies that have actually lower volatility, as history shows us, than the benchmark. I think it's really, again, that idea that you want companies that have that strong balance sheet, not buying the entire index, but aren't going to be in that cyclical growth cycle that over time can really complement more of an index-based strategy in the EFA landscape. Now, BKCI was only launched back in December, so we don't have a whole lot of data to show. But if you look at other strategies that Walter Scott runs that follow this similar stock selection process going back 20 years, they not only have lower volatility than the benchmark, they have lower volatility than most of their peers as well. And I think, if we look at the composite we have for the concentrated version that BKCI is run off of, and we look at that blended just 50-50 with an index-based solution in the international landscape, you actually significantly increase your risk-return profile. So I think it's, again, in times of uncertainty, especially right now in certain asset classes like the international developed equity space, it's really, I think, a good idea for clients to look for those diversifying opportunities through a product like BKCI.
Thanks, Matt. Appreciate the insights. And thank you, everybody, for joining us for ETF 360. Tune in next time.